In this week's video, we're going to follow up on the discussion we had the previous video in relation to valuations, and then we'll touch on some of the macro indicators for asset allocation. But initially, just turning our attention to valuation. So we're looking at the major asset classes and a range of valuation tools to create a composite valuation indicator. In the case of Australian equities, that's the blue. You can see these are the range of outcomes. These are Z scores on the left-hand scale, so -2 up to about plus 1.75, and the red dot shows the current position. The shaded or the coloured area is the sort of the 50% or the where it spends its majority of time. So as we can see, just eyeballing the chart, Australian equities are towards the expensive side in terms of valuations. Global equities also in that situation. We also have REITs looking quite expensive. High yield, not as expensive, but certainly not cheap. Then we have Australian bonds and then global bonds. So I guess the key message here is that pretty much all asset classes are deemed to be relatively expensive at the moment. Of course, in the discussion last time we talked about the equity risk premium. So if we just now add those to the chart, and we get a slightly different picture, and it's that is, I guess, forcing people or enticing investors into equity markets, despite these what are perceived to be high absolute valuations. Now, I should note that these valuation measures include a range of indicators, whether that be CAPE type PEs, forward PEs, earnings yield, bond yield, dividend yield, trailing PE. There's a range of different indicators that we use. If we add in the equity risk premium, as you can see, that comes up as the most recent one. So for the US, the equity risk premium is currently sitting around about 6%, so it's towards the upper end of the range. So that would tend to make the US equity market look relatively cheap. What does it look like for Australia? Well, similar, and even slightly cheaper, an equity risk premium above the normal range and up around about 7%. If, however, we introduce normal bond yields or normalized bond yields in both markets, let's do the US first. And you can see here it now has the US equity market or the equity risk premium back. Maybe it's still slightly attractive, but certainly back within the typical range. And for Australia, if we introduce normalised bond yields, we get the market back in the middle of a fair value range. So as we sit here today, absolute valuation measures might be giving a negative outlook on asset classes relative, or the equity risk premium looks attractive, but if we normalise for bond yields, the asset or the equity asset classes are around about fair value, maybe slightly, very slightly on the attractive side. We'll now turn our attention to some of the macro indicators for markets. First one I want to look at here is US data surprise. So we use about 12 indicators, the key or the major indicators in that one. And I guess the observation to make here, and I should say that the data surprise index is the orange area chart down below. So after spending a period from about 2014 or the mid part of 2014 through to a couple of months ago, it spent most of its time in underwhelming expectations, and of course that was a factor that helped draw bond yields even lower still. It's only been a few brief periods over this last 5-6 year period where it's been above expectations. Back in 2010-11, you can see here also 11-12, and a period during 2013, and also a brief period in the first half of 2014. But this is the first time for about a year and a half that we've seen data surprise move to the slightly positive positive reading. What about some of the other indicators, macro indicators? We also consider G4 growth momentum. So that's essentially looking at growth rates in the most recent month relative to the 12-month moving average. So that's the red line. You can see here in February it was quite negative, and it pushed up to a positive outcome and has basically stayed there ever since. So we've seen a recovery in growth momentum. Normally that's associated with the turn in the IP cycle or industrial production cycle, but also it's typically associated with outperforming equity markets, and they're represented by the blue bars, as you can see here. So data surprise has been positive. Growth momentum has also been a positive and continues to be a positive for equity markets. And then finally, if we consider a similar measure, once again, we're looking at G4 growth momentum. That's now the blue line, and that's on the right-hand scale, so it's above zero and it's positive, as you can see here. That's the series going back for about 20 years. And alongside that now, we're not doing just equity returns, we're doing equity relative to bond market returns, 6-month change. And so, the two have followed each other reasonably closely over that period. What we saw, if we just update this for the most recent data, what we can see now is that equities have outperformed bonds by around about 7 or 8% over the past 6 months, after underperforming by around about 10%. So after a period of quite considerable divergence, more recently, the divergence has since diminished. And what we would say to that is that equity markets have now largely responded to the improvement in growth momentum, and to push further from here would need an even bigger improvement in growth momentum.